fit into that bucket are properties that are not stabilized, meaning they're less than 90% occupied. So half an empty building can be a steal, but there's a heavier lift because you need to really, find ways to push occupancy up and bring a lot of tenants, or property that is very old and you need to invest a lot of money. I like the light to medium range of value add of lift. So we would usually take a building that is, or an apartment, complex that is in a decent shape, and we only need to improve the cosmetics or just make the interiors a bit nicer.
Welcome to the Wealth Through Real Estate Investing podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and reach the lifestyle you always wanted. And now your host, Dwaine Clarke.
Hello and welcome to the Wealth Through Real Estate Investing podcast. This is your host, Dwaine Clarke, and today we have Ellie Perlman. Ellie is a multifamily real estate investor and founder of Blue Lake Capital, real estate investing firm specializing in multifamily real estate investments. Ellie is also the host of Ready to Scale podcast. Ellie, thank you so much for joining us on the show, and how you doing, my friend?
I'm doing great. How are you? I'm happy to be here.
Thank you as well. Happy New Year to you. I know it's another big year. I know you guys working on a lot of different stuff. So very interested to learn more about it and a little bit more about your business. But before we kick things off, would you mind talk a little bit about your background, how you got started in real estate?
Yeah, absolutely. So my romance with real estate actually started about over a decade ago. I started my career as a real estate lawyer, and I figured out, pretty early on that it probably makes more sense to be my own clients than to be, a lawyer. And I was very intrigued by looking for adventures and new properties, and I really wanted to be there. The next step for me was property management, and I worked for a very large company and managed assets over $100 million. And after that, I felt ready to move to the business side and to the investment side. So I actually moved to the States about 5 years ago, and I went to MIT, spent 2 years in business school, and learned everything there is to know about how to start a company, how to create financial reports, and how to manage people. And then I felt ready after I graduated, basically, to start my own firm, Blue Lake Capital. And, what we do is it's a very, very simple model. I mean, it's simple to understand. It's not that simple to implement, obviously. But we purchase properties, multifamily properties in Texas, Florida, and Georgia, usually 100 to 400 units. And we do that with investors. So we put some of the, down payment, and investors are bringing their own money. And we're not only finding the deals, but we also sign on the loan and we manage the asset. And the business plan is to find those properties that have some potential, some value add, some value that we can add to the property, like renovations and cutting costs and expenses. And that's how we basically increase revenues. And we hold properties for 3 to 5 years and then we sell them. So that's basically what we do.
Awesome. Are you guys primarily like a one-stop shop where you guys are, acquiring the deal, raising the funds, doing the third party, asset management, or you guys also, partner with other sponsors?
Yeah, we are partnering with other sponsors, but we are a one-stop shop. Like you mentioned, we raise the capital, we find the deals, we basically manage the assets, but we are open, to JV, and we've done it before, where basically if someone comes to me with, a good deal or anything that they can somehow add value to our company, then yeah, we are pretty much, open to partner with others.
Awesome. And then as far as said the markets you guys are, said Georgia, big presence in Texas as well. What was the other one?
The other one was Florida.
Awesome. And what were kind of some of the characteristics that kind of drove you to those markets? And are you guys also eyeing some different markets as well?
Yeah, well, Dwayne, that's a really good question. There's so many markets out there, and it looks like everyone is making money in real estate right now, and all markets are great. But really, what really drew our attention to those three markets are five main factors, and the first one is population growth. So I always want to be in markets where people are moving to because people fuel demand, and that means the more people that move to a certain city, the more demand there would be for my units or my apartments. So all those markets, and within Texas, Florida, and Georgia, we're not buying all across the state, but we're buying in specific MSAs. So Atlanta, DFW, Jacksonville, Orlando, these are kind of the main markets for us. And because those markets are strong with population growth, and also job growth is very positive, and they kind of related because the more the higher the number of new employers that move to a certain MSA, the more people that would come for those jobs. And also rent growth, because I want to be in a market that has good increase in rent, so like we can push rents, and because that's basically how we make money. The fourth factor is a landlord friendly state. So I live in California and I love living here, but unfortunately, as a landlord, it's a very challenging state because if
Mhm.
someone doesn't pay the bill, doesn't pay rent, it can take me 9 to 12 months to evict them. And in that time, I'm paying for all the expenses
Mhm.
and utilities sometimes. So I really wanted to be in states that buy in states that are really pro landlord. So if someone doesn't pay, if we need to evict someone who's trashing the apartment, within 10, 14, 21 days they're out. And the fifth factor is positive appreciation. I want to be in a market that actually appreciates. So in 3 to 5 years, when we turn the property and put it on, for sale, then we're actually able to sell it for the highest price possible. And
Mhm.
core markets like New York, San Francisco, LA, they're very poor in cash flow, and they're very usually if you time it right, the appreciation is very significant. And then you have markets in the Midwest that, when it comes to cash flow, they're it's more significant, but the appreciation factor is not there because prices don't increase as much.
Mhm.
And in Texas, Florida, and Georgia, it's just the right mix between solid cash flow and also solid appreciation. So if one of those two factors, if both of them are strong, that's great. But if one of them is not as strong as you have predicted, you have the other factor to compensate for it. And
Good
that's why I
point.
love
Yeah.
those markets.
Absolutely. That's a very good point there. You had mentioned kind of your business plan of, getting in and out of a unit of your properties within like a 3 to 5 year, or that's kind of like the plan. Are you guys, for the properties that you guys, acquire, is it more managerial stuff? Or are you guys doing some heavy rehab to kind of get a significant amount of the value add out of it? Or to kind of do it on a deal by deal basis?
So, Dwayne, I'm a very conservative investor and a syndicator, maybe because I used to be a lawyer and that kind of shaped my philosophy, my investment philosophy. So I'm not crazy about the heavy value add, heavy lifts. And when I say heavy value add, it means, if we the type of properties that fit into that bucket are properties that are not stabilized, meaning they're
Hmm.
less than 90% occupied. So half an empty building can be a steal, but there's a heavier lift because you need to really find ways to push occupancy up and bring a lot of tenants, or a property that is very old and you need to invest a lot of money. I like the light to medium range of value add of lift. So we would usually take a building that is, or an apartment, complex that is in a decent shape, and we only need to improve the cosmetics or just make the interiors a bit nicer. Instead of a carpet, we're going to put forward flooring or vinyl flooring. Maybe paint the doors, the cabinet doors, for instance. Maybe put granite instead of whatever is there. So even though the returns are not as high, they're pretty high. We're talking about, 8 to 9% cash on cash, 14 to 17% IRR. So they might not be as high as a heavy lift, but I think it's a pretty significant return nevertheless for a much lower risk.
Absolutely. And because I talk to other sponsors, and sometimes since they're doing more heavy lifts, that is not, cash flowing day one, but if you guys are doing, 90%, occupancy, then you guys can be cash flow, make the investors happy, improve the
Mm-hmm.
property, and then eventually sell it. So that's definitely a smart conservative approach right there. So that's really nice. Can you kind of take us through maybe like a case study example, maybe one of your latest deals or one of your favorite deals that, you implemented a business plan and it just worked out great and you just kind of like that overall deal?
Yeah, I can actually talk about two different deals and how one of them there were no surprises. The other one there was a big surprise in how we dealt with it. So, first deal and it was actually a pretty neat deal because the owner already renovated all the units, and only 3 months prior to selling the property started pushing rents by $250. And
Mm,
that was over 20 to 25% rent increases. And the property was still 100% occupied. And what we did when we purchased the property, basically, we didn't have to do much. For most units, we didn't even touch them in terms of their interior renovations, and we just increased rents. And that was a relatively easy, case, but you don't find a lot of those deals because
yeah, right.
usually
That's
what happened there is the owner was actually a contractor and he didn't like to manage those multifamily properties. He was more into development, but because he had an in-house team, he got all the materials at cost, and he probably saw all the work as a sunk cost anyways. And so he just wanted to keep the property at 100% occupancy, which is not ideal because usually it's a signal from the market that your rents are below market. And that's
hmm
exactly what he did. He kept the rents low. He renovated the units and never, charged any premiums. And when we came in, we just pushed rents every time someone, the lease was up, we renewed it at $250 rent premiums or brought new tenants that were willing to pay that much. And then another case was basically a property that when we were negotiating with the seller, it was at 98% occupancy, and less than a week before closing, we actually found out that the property was 82% occupied.
Oh,
So
wow.
occupancy dropped significantly, and what we've learned was that the owner decided to bring a third-party company to manage the asset because he was managing the asset himself, and he wasn't doing a great job. He brought a third-party company, and they've decided to evict a lot of people. And all of a sudden, there was a huge gap in occupancy. And we had to go back to our lender because usually I only buy stabilized asset 90% occupied for 90 days because I want to get the best loans out there, which
hmm
are agency loans from Freddie Mac and Fannie Mae, which are government-based, agencies. And that means that I can get the lowest possible interest rates. And now we're at 82%. And I knew that the property was good, that it had good fundamentals. The potential for value add was amazing. And we just had to deal with the lender. And basically, we went back to the lender and convinced the lender to keep the loan, even though it didn't qualify. It was far from being qualified because we were no near 90%. So within about 45 days, we were able to bring the property back to 90% and stabilize it. But it was, we hired a really good property management company. And I spent about a week there after we closed. I flew to Atlanta and spend time there to actually make sure that we're able to turn the property, around. And so you always have surprises, and sometimes it goes according to plan, and sometimes it doesn't. But that's those are two very unique, cases, because usually you don't get a property that has been renovated without any upside,
Hmm.
by that the seller collected, and you don't get a property that all of a sudden is not stabilized if you thought it was stabilized. And but usually we don't get those surprises, but these were two very, very interesting deals.
Yeah, the last one was very interesting as well, because a lot of times I know a lot of these sellers don't want to kind of make the property look, kind of stand it up as much as
Hmm.
they can. And again, you mentioned, signs of red flags if you see it 100% occupied. But they brought in a more professional manager, and they kind of, looking at the books and say, well, we got to kick these people out in order to kind of, maintain it. So yeah, that's definitely good. And that, especially like the first one where it's $250 worth of premium. That's just like, that's really good. And not having to do much
Yes.
work, anybody would take that deal. So.
Yeah. I mean, that's the beauty in getting off market deals for sure. You have those players that are not that experienced sometimes with managing the asset, and you have a lot of upside.
And then I noticed you had because you write a lot of articles and stuff like that, and you write a lot of stuff through Forbes and stuff. And you mentioned one time about the off market deals. You just kind of mentioned it, kind of prompted me to ask. So, is there any other ways that you find? Is it through referrals, or you guys are kind of actively maybe reaching out to property managers, or what's the best way that you guys work to get off market opportunities?
So the best way for us to get off market deals are through brokers. We invest a lot of time and energy in cultivating those relationships. And when there's an off market deal, usually, because we're buying 100, 200, 300 units, usually those owners are not marketing directly
Hmm.
to buyers. It's not, a single family home or 20 unit apartment building. They still want to go through a broker, even if it's off market. So the broker would take it and, offer it to three, maybe four groups. And that's for us, that was the best way to get off market deals. Sometimes property management companies will have information about local deals that are traded, or under the radar and off market, so that could be a potentially another source of off market deals.
Absolutely. And as far as, because for you guys to kind of expand, continue growing the business, can you kind of talk about, raising capital? What has, I know there's multiple things that goes into it, but what, kind of work best for you guys, and, you know, building your brand, building your company awareness, and ultimately leading to some new potential investors?
Yeah, so our number one source for capital raise came actually through social media. And we put a lot of effort into really providing value to passive investors. And every time we wrote an article, the main thought is, what's their pain point, what are they interested in, what do they want to read, and try and answer those questions on everything that we post. So as you mentioned, I write for Forbes. I also have a blog, and I also ask questions on my own podcast, Ready to Scale, that some of that content is very, very tailored to the passive investors who want to learn more about investing in multifamily with a syndicator. And that has been the number one actually source. And so a lot of investors going to my website, and they reach out to us through the website actually.
Awesome. And I was saying, along with kind of putting out a lot of information, adding value, I noticed that you guys are hosting an upcoming webinar on acquiring multifamily property. Can you tell us a little bit about that?
Yeah, so we're basically going to talk about the process of acquiring a multifamily, uh, you know, deal, purchasing real estate in general. It's basically something that you can adjust to any type of real estate. It's more geared towards syndicators and how to manage the process from sourcing deals. When I say sourcing, meaning, where do you find deals? What are the different steps along the way until you basically close the deal? It's also interesting for passive investors to learn how things are being done behind the scene. And
Hmm.
so, when you raise money, you are not closed yet. So you're kind of in the in between process. You're during the due diligence process. And as a passive investor, if you understand the process, then you also understand the risk. And it's interesting to understand, even if you don't do all that, you kind of need to know, even in high level, what are the different stages, because the company that is basically is in charge of your money and managing it for you, that's usually the steps that those companies take. And just being aware of it can really be an eye opening and maybe help you mitigate some risks. Because let's say if I start raising money, I'm still in the due diligence process, then what happens if we find something that would make the deal not worth it? If there's, for
Mm-hmm.
instance, an environmental issue that we can't close, or if there's an issue with the lender and we can't get the deal, like what happened with my last deal, then what happened? So as a passive investor, you need to know what questions to ask and be comfortable with it. So for instance, for us, if the lender wouldn't have been willing to extend the loan and the deal fell apart, then all the money would have been, of course, sent back to investors. But you got to make sure that the syndicator that you work with has enough cash flow that he or she are able to do that, because along the way we have a lot of expenses. The for the deal that I just was talking about in Atlanta, we spent over $500,000 before we closed, and of course some of it is being reimbursed because they're costs, part of the closing costs. But
Mm-hmm.
as a passive investor, if you don't understand that, if you are not aware of the process and the costs, and you wired the money, some of it is used for for reimbursement, then you have to understand that there's a risk if you're working with someone who's not liquid, because the deal falls apart and they spend $500,000 but they don't have that money to return, and potentially could be an issue. So I
Mm-hmm.
think this webinar can definitely be interesting for both syndicators and for passive investors.
Yeah, definitely, Kay. I like that how you phrase it there. Is just like so just if you know more about it, it feels less risky. Understanding the process. And of course, not many people are familiar with the syndications and how things work. And they just want to think that they're just sending their money and things happen. But if you are more educated, you feel a little bit more comfortable, and then you have more confidence in the whole
Mm-hmm.
overall project. And then kind of leading to you educating more through your podcast. I know you have a lot of different guests on a lot of different topics, as well as you speak on different topics as well. Can you kind of tell us a little bit about the show and what people can expect when they hear it?
Yeah, absolutely. So the show is now on its second season. The first season we called it Unbelievable Real Estate Stories. And it's basically hosting a lot of investors and have them share their stories and what they've learned from it. And that's one way of learning. The second season is called Ready to Scale, and it's more about how you can scale as a passive investor and as a syndicator, how you can scale your business, your investments, your portfolio. So we have investors that are sharing how they're investing with multiple syndicators and able to acquire a lot more real estate. And we also have syndicators that are basically talking about certain, investment and how they're able to scale. So we basically cover three kind of buckets in each interview. One is we start with asset, because each investor tells about what asset they are focused on, talk a little bit about that asset class. It could be student housing, multifamily, mobile home parks, any type of asset that is out there, because really the goal is to expose the audience to learn about as many assets as possible, similar to what you do. And the second portion of the interview is about strategy. What strategy are you using? Because you can have, two investors that are buying the same asset, multifamily, but one of them is doing, like you mentioned, can be very challenging, or maybe not challenging is not the right word, but heavier lift. And
Mm-hmm.
maybe they flip it even after 18 months. And some of them are holding it for a longer period of time, and they do a more moderate, value add. And so that's the second part. The third part is process. We focus on one area in the business, and the guest is basically sharing part of his or her process. If it's about raising money, or managing the asset or working with syndicators, whatever it is, what are the tools, what are the tactics, anything that has, process in mind as part of that interview.
I like that flow a lot. That's kind of because, like I said, I like hearing different stories from different people, how different things, and of course, adding the asset class is even better because some people just like different things, or they want to diversify their portfolio, or are interested in different types of projects. So that's awesome. Learn a little bit more about you. What's like a typical work day, and do you have any special morning routines?
No typical days actually, because some days I'm in the office working, some days I'm flying to Texas or Florida to walk properties, some days I'm negotiating with sellers. So my day is pretty much, there's no one typical day. I am devoting my time between overseeing the marketing efforts in my company and managing the acquisitions team as well, and talking to investors. And a morning routine, I try to work out every day. I think right now I'm on average, I think right now it's 4 times a week, which is not enough. I'm trying to put it as part of my morning routine. So I start with working out, and then I have the entire day to work. So
Hmm.
my day is not caught, I don't want to cut off my day and leave to do some workouts. I'm trying to make that my new morning
Yeah,
routine.
awesome. And then with all like your success and all the projects you guys are working on, what can you say that you're most grateful for?
Most grateful for two things. My partner in crime, my husband. He, I'm very, very grateful for him. He, has been extremely supportive. He runs his own water technology company. I run Blue Lake Capital, and he's been great. And I'm also very grateful for my background, which without it I wouldn't have been here. I grew up in a very poor family, and had the desire to build a life for myself and succeed. And that really pushed me to achieve things that other people said that it might be, impossible, or it might be extremely difficult. And I realized at some point that I'm a challenge, junkie. So if there's a challenge, I'm there. It's very, very satisfying to overcome the challenge, and I learn from each and every one of those challenges.
Awesome. Very well said. So, how do we get in contact with? I know we have Ready to Scale podcast. Is there any information you can share with us?
Yeah. So basically, if someone wants to reach out to me, you can just Google Ellie Perlman on Google, and my website is ellieperlman.com. If you go to the website, you can download, for free, the top 5 critical deal components that any passive investor must examine. And it's basically tells passive investors what they need to look at when they invest passively with a syndicator. You can also reach out to me directly, Ellie at bluelake-capital.com, and Ellie is ELLIE.
Awesome. Well, Ellie, was a pleasure to speak with you. I'm finally glad that you was able to slip us into your schedule. I know you're very busy, and I really appreciate you taking the time and talking to me and our listeners. And have a great 2020. Look forward to connecting with you again soon.
Thank you, Dwaine. It was my pleasure.
All right, take care.
Thanks for joining us on this episode of the Wealth Through Real Estate Investing podcast. Don't forget to subscribe and leave us a review on iTunes or the listening platform of your choice. Also, please check us out at DwaineLClarke.com, as well as find us on Facebook for more useful content and resources.